we have 2 chapters relating to inventory and around 20 marks, right, coming for the VC out of 100 from inventory, right? So which means it is very important, yeah, right? So then I thought of saving some time, so I just printed tute, and then halfway through in the tute you can see some notes are there. So because I could have printed everything, but I don't like that. I still want you to involve, right, or work on the theory, right? That's why I just gave you like that. Okay, so let's start, guys. First of all, everybody knows what inventory is, yes? So in unit 3 and 4, what do we deal with?
Trading business.
Trading business. What are trading business, guys?
Businesses that sell, buy and sell inventory.
Yes, purchase and sell inventory. Basically they purchase and then sell them at a profit. Right? Then what is the importance of inventory? So inventory is the, first of all, main source of item that generate revenues for the business, right? Because the trading firm will sell their inventory to make money, yeah? Right? And then what else? It is the most significant asset. Why is that most significant asset? The reason is the inventory asset will determine the value and the strength of the other assets. Because if we have more assets, what will happen? If we have more inventory, relatively to the magnitude of the inventory, we will have other items as well, other assets as well, right? And also this is one of the susceptible assets in the business. What do you mean by susceptible? Susceptible, that means exposed for the risk of stealing. Very good. Frauds. Thank you. For some fraudulent activities, right? Why is that? After money, inventory is the most vulnerable asset. Means exposed to the risk of frauds or misuse, right? So some people, maybe including staff members, sometimes can steal inventory, yes, and also I have seen customers also steal inventory, right? In a supermarket especially, right? Some people run away with bucket load of goods, right? So then, as a result, what do we have to do? We have to pay attention to the inventory, and also managers or the owners, you have to have practices in order to minimize the loss of inventory, right? Okay. Now we are going to do, guys, inventory valuation, right? What does that mean? We are going to value the inventory, yeah? We are going to value the inventory. Right? So there are many methods that we can use to value the inventory, but the thing is, in your study design we have only 2 methods, right? To value the inventory we have only 2 methods, right? You already know what are those. What are the 2 methods that we use to value the inventory? No? You have done in unit 2. No idea? Yeah?
Is this stock take?
Yes. Stock take, yeah. We have 2 methods. What can I say? Or maybe like we can say processes to value the inventory.
There's first in, first.
Yes, FIFO and identified cost. Yes. Okay. So we'll write a small note first of all for the inventory valuation, guys. Right. for the inventory valuation, right? This is the process of finding the value of inventory at the end of the period, and the cost of sales of inventory in the current period. First stop, there are two methods of inventory valuation. Right? First one, identified cost method. Right? Second one, first in, first out method. So we call that FIFO acronym. Right. First of all, I'm pretty sure all of you know what identified cost and FIFO is. Let's recall your memory. What is identified cost, guys? Identified cost method means we mark or label the cost of each and every individual unit of inventory, right? We know that when we scan it, or maybe we will have a secret code to identify what the cost is, right? In each and every method, in each and every item. Then the other one is first in, first out method. First in, first out method, we don't physically mark or label the cost price of the inventory. Then instead of that, what do? We will have an order where we will issue or we will sell the inventory that we first purchase. So whatever the inventory we purchase first, or whatever the oldest inventory is the one that is going to be sold or that is going to be issued out of the premises. Right? Okay. Right. However, there is a small problem with FIFO. What is that? What we do is we don't really identify the inventory physically. We just follow what? The cost. Only we follow the cost. We don't physically, right? We don't physically determine the cost. We assume we follow the cost only. Does that make sense? Right? Make sense? Or you want me to explain it? Everyone is okay? Right. If you want me to explain, I can explain with an example. Right. Then, first of all, we'll follow identified cost method. Right? What are the benefits of identified cost? So, these benefits and cost, or advantages and disadvantages, guys, they come to the exam. Right? So, then you need to know. Right? You need to know those benefits and cost. First of all, take down benefits of the identified cost. Right there. Identified cost is accurate, and neutral. Thus it provides a faithful representation of the inventory value. Okay. Number 2. Identified costs does not follow any assumption therefore the profit and cost of sales are reported accurately. Right. Now, do you understand this one? In identified cost method, as I told you, unlike FIFO, right? FIFO I haven't still explained much, but remember I told you FIFO is following an assumption. What is assumption? We assume that the first inventory that we purchase will be the one that will be sold. But really, it's not the physical item that we received first is sold. It is actually we follow the cost. The cost of the first batch of inventory is what we are using to issue, right? Not really physically, right? Okay, so then in when it comes to identified cost method, we don't really follow any assumption. Therefore, the cost of sales and the profit of the inventory is reported accurately. And on the other hand, identified cost method is 100% accurate and neutral. As a result, we know that the inventory value or inventory valuation is giving us an accurate or faithful representation of the inventory valuation. Right. At the same time, we have some disadvantages as well. Right. So write the first one. It is not always possible to mark and label individual items.
Mutual items?
Individual items of inventory. Do you think so? We can't always value them individually. Example.
Strawberry.
Sorry? Strawberry?
Yeah.
Yeah. Correct. Petrol. What can we mark it always? Can we have a price tag? No, I can't have price tag. Petrol. And cotton. Because the reason, whatever bulky items, we can't do that. It's hard. Second one, it is expensive. In labeling, individual items and recording codes with cost prices. Right. So still we can label them, right, when we follow the identified cost method, but it will be expensive. Okay. Right. I will do the benefits of FIFO. Number one, FIFO. Now basically once you remember one set of benefits and cost, it is the opposite for the other one. Now for example, cost of identified will be the benefits of FIFO, yeah? So right there, FIFO can be applied to all types of inventory. Number two, it costs less for inventory administration. Then identified cost. Right. Now remember, we said that in the disadvantages of the identified, we said that it can't be used for all the inventory. But this one, FIFO, can we use for any type of inventory? Yes. Anything we can use. Also, it will cost less. It is less expensive compared to the FIFO. Compared to identified. However, do we have disadvantages in FIFO? Yes, there's only one. Right? Take down. FIFO being an assumption. Cost prices which are allocated to individual inventory items. May not be as accurate as identified cost. First of thus cost of sales and inventory may not be perfectly accurate. Right. Now what is the disadvantage of the FIFO? Now remember, what is the main advantage of the identified cost? Identified cost method is accurate and neutral. Why is it neutral? We don't have any opinion. What opinion? like in FIFO. FIFO we have an opinion or assumption that we are issuing the inventory that we received first, right? I mean, whatever the inventory we received first is issued first, but which is not there in the FIFO. Why? Because FIFO we do follow an assumption. As a result, it may not be as accurate as the identified cost inventory valuation. Does that mean we are going to say this is wrong or incorrect? FIFO, are we going to say it is incorrect? No, it's not incorrect. Don't misunderstand. It is correct, and also it is acceptable by the Australian Accounting Standards Board, right? Right. So that, do you know, like there is an organization called AASB, Australian Accounting Standards Board. So they are the one who impose rules for the accounting records. So then FIFO is still identified as recognized as an accurate method. So however, this one doesn't mean that FIFO is incorrect. FIFO is not as accurate as identified costs. That's the only problem. Right. Okay, guys. Right. Then, any questions up to now? Any questions? Right. Now, as I told you at the beginning, we are going to talk about very specific transactions. Okay, I know very well most of your schools don't teach these things, so that please listen carefully. Okay, very important. Right. Now, identified cost method, I'm not going to talk like much after this one. The reason is identified cost method is very easy, right? Why is that? Identified cost method, every time they'll give you the value of the cost prices, so it is not that challenging. But FIFO is the one that is challenging. That's the one, it has some harder parts. Okay, this is the first thing. The first thing is valuation of cost of sales for the sales returns under FIFO. Right? We are going to value the cost of sales for the sales returns. Now remember, guys, did we value the cost of sales before when we did the sales returns double entry? Did we value? Yes. How? How did we mainly value? What method? Identify? No. Identify we are just learning now. I'm asking, did we value the cost of sales when we record sales returns double entry? How did we value? Markup. Mainly, thank you. Mainly we use the markup, yes? But in this case, what are we going to do? By looking at the inventory card, we are going to value them. How? Now please read this one. Yep, finish reading. No, does that make sense? Basically, what do we do? On sales returns under FIFO, what we do is we assume, basically what this one says is the last item to leave the business or last inventory item that left the business is the first one to be returned. That's what it says. Okay. Why do we do that? That is also actually following the FIFO, right? To make sure that the FIFO is followed. I will explain you how it happens using an example. Okay. Before that, guys, please we have to fill in that blank right there. Reversing FIFO means that the last inventory items out under any source document between brackets, right, or any type of transaction would be, close bracket, would be the first items to be returned. Right, please read that one. Okay, guys. Right. Okay, next one is, does that make sense? Reversing the FIFO. Reversing the FIFO means any transaction that we are that we had um, an inventory going out of the business will be the first item that will be coming back in terms of sales returns. It can be any transaction. Right. Then next one, calculating the cost of sales under any method of inventory valuation. What do you mean by any method? FIFO or identified cost. Right there. In the out column, comma, add all the values that are supported by the source documents of receipts, comma, invoices and EFTs, comma, then subtract credit notes in the in column from that addition. Okay, does that make sense? In the out column, how do we calculate the cost of sales, guys? In the inventory card, we go through the out column, right? And then we add all the values that are supported by the receipts, invoices and EFTs, which means we don't identify any other, maybe memos or anything else or credit note, we don't add. Then from that addition, we will subtract the credit notes in the in column. Why do we subtract the credit notes in the in column? Because they are the sales returns. Very good. We subtract the sales returns. Why do we exclude the memos in the out column? Because those things haven't been sold. Because such inventory haven't been sold. Yeah, that's why we subtract. We don't consider the source documents except receipts, invoices and EFTs. Right. On the other hand, cost of goods sold is what? All the purchasing cost of inventory that has been sold. Right. Then guys will do evaluation of inventory losses under FIFO. Right there. Right. For inventory losses, what do we do? FIFO is applied normally. What do we mean by FIFO is applied normally? We assume the first inventory is the one that has been lost, right? Okay, so right there, where the oldest inventory on hand is assumed to be lost first. Right. Then the other one. How do we value the inventory gains under FIFO? Right? we assume that inventory has been gained by the most recent in transaction recorded in the inventory card. Okay, whatever the transaction that has resulted to record in the in column in the inventory card. Okay, right there. FIFO values inventory gains using the most recent or latest value of inventory that came in. First up, these values can be from any type of inventory. Right. Now this one I think we have written before this one. What are the reasons for inventory losses, regardless of the method?
Theft,
Very good. Inventory theft. What else?
undersupply,
Undersupply by the
supply,
supplier and
oversupply to the customer,
oversupply to the customer and
Damage.
damage. Very good. So we'll write there. First one, inventory theft. Second one, inventory damage. Undersupply by suppliers and oversupply to customers. Right. What are the reasons for inventory gains?
oversupply by supplier,
Oversupply by the suppliers,
and undersupply by to customer.
undersupply to the customers. Very good. First one, right? Oversupply by suppliers. And second one is under supply to customers. Okay. However, this second method is not considered as a reason for reason under the FIFO, because you know the reason. The reason is actually what we assume is, right? Remember how we valued how we valued the inventory gains under FIFO. We assume that the last inventory that caused the inventory to increase, or the last transaction that we have recorded in the in column in the inventory, is the one that has increased or that has created the inventory gain. So then let's say if we have undersupplied to the customers, most probably what can happen? What will happen? If you undersupply to the customer,
They'll come back.
customer will come back. Very good. Customers will come back, yes, right? So then as a result, under the FIFO, we don't really identify it as a reason, right? Okay. Now guys, before we go any further, the other one. What is the double entry for inventory loss? Inventory loss is what? Is an expense or revenue? Expense, yes. Expense increases. What's the double entry for expense? Inventory decrease and expense increase. What's the expense term? Expense called? inventory loss, right? Inventory loss is debit and inventory is credited. Then for the inventory gain, what's the double entry? Which is a revenue. Inventory increases, inventory will be debited and credit the inventory gain, because why? Revenue increase. Okay. I didn't actually include it here. You want to write the double entry? Yeah? Okay, then take it down. Probably please write it in your book. Okay, guys. Right. Shall we do this question? Right. Now see how do we approach the question, guys? You can have a glance through the question and then read the requirements. Part A, explain how inventory is valued under the identified cost method. Theory question. Part B also, why it is ethical to include in the same sale an inventory that has been purchased at different cost prices. Record the transactions in the inventory card and record the transactions in the general journal. and calculate the cost of sales, gross profit and adjusted gross profit. Right? Right. Firstly, how do we value the inventory under identified cost method? Yes. What did we say for the identified cost method? Each and every inventory, what is sorry?
Each and every inventory has its own value.
Yes, because we have labeled or marked, yes, the value. Okay, please write there. Identified cost method. Method marks or labels each and every sorry, my bad. Labels the cost of each and every inventory unit. Right? Right. Part B. Why is it ethical to include in the same sale an inventory that has been purchased at different cost prices? What does that mean? When we purchase the inventory, we would purchase at different prices. But when we are selling it, what will happen? We will sell at the same prices. Is it ethical? No. Why is it ethical? They're asking. We can't say it's not ethical. Then we have to support the question. They're asking, explain why it is ethical. And then we have to actually support the question. Yeah. Why is it ethical? Because we are selling the same or identical or homogeneous products. Yeah. Please write there. It is ethical because all such inventory items are identical. For the customer, thus charging the same selling price. Right. Okay, guys, now let's start the recording. Okay. So, this man, James Cameron, uses what method? identified cost, yes, right? And then he's having 40 video cameras at 240 each. Do we add the GST here? No, we don't actually increase the or we don't include the value of GST in the assets, yeah. Except accounts receivable, we don't include the value of GST, yep. Okay. So let's write it firstly. 40 at 240. It's recorded. Right? 40 at 240. Right. Then, second one. Purchase 20 cameras for 250 each. Right? So then, invoice C745. So we'll write the, we don't have to repeat the month again, we can just write 2. What do we write, guys, in the details column? Invoice C743, yeah? So 45. All right. What's the quantity?
20.
At 250, yeah? Total 5,000. Right? Then what's the balance, guys?
42 at 240.
Very good. We had to repeat it. We had to repeat the previous balance, yeah? Because now we are on in a new date. So we have recorded, because as of May 2nd, if somebody sees that, somebody wants to read the inventory card, then we have to carry down that whatever the balance we had last time. So then we have to repeat it, and then this is a different price, so we can't add them together, so we have record separate. Don't worry about the dollar mark, okay? Next one. Sold 35 cameras, right, at 500 each. Invoice 76. 23 valued at 240 and 12 at 250. So this is identified cost, guys. Then what do we do? Yep. So we write May 4th invoice 73. Yep. What do we write? Yep. 23 at, sorry, not 76, 73, 76, yep. Alright, we are selling 23 at 240 and 12 at 250. 12 at 250, I can tell 3,000. 23 at 240, 5,520. Yep. Thanks. Right, then what is the remainder, guys? We have 17 at 240 and 8 at 250, up. 8 at 250, 2,000. 17, how much? 4,000? 80. Right. Next one. James, the owner, took home from inventory 2 cameras, 250, right? With an identified 250 each. It should be 250 each. So that means he is taking home 7th. In or out? Memo 34. 2 at 250. 500. Then what do? We will record 17 at 250 as it is, 240 as it is, and 6 at 250, 1500. Right, then 12. Right, GQ design, return 5 of the cameras it purchased on the 4th May because the color was wrong, and granted a credit of 550, credit note 21. Cameras were identified as having cost price 240. Okay. Credit note 21. Coming in or out? In. How much is the value? 550?
No, 240.
240. Which one? Some people say 550 or some people say 240?
240.
240. Why is it 240, Gavish?
Because that's the price of the inventory, and the cost of the sale isn't relevant to the sale price.
Yeah, remember. Listen now, everybody. Right? What price do we record in the inventory card? Cost price. We don't record the selling price. Okay? Patul? Yep. So we record the cost price, yes? Not the selling price, always. Right? Okay, so remember that. Then we are recording coming in or out? In. Why?
Because we're getting the inventory.
We are getting the inventory as, right, 5 at 240, which is 1200. Then we have 12 at 240, not 12, 20, 22, yep. 240, 5280, and 6 at 250 as it is. Right. Then on the 15th, return to Fisher Quicks the 5 cameras returned by GQ Design for a total credit of 1320. Now what happens? Now we are returning it back to the supplier. Yeah? 15. Credit note A56. In or out? Out. Everyone is okay? In or out? Out, yep. Yeah. How many? 5. What's the price?
It says total credit 1320, but that doesn't matter, right?
It doesn't matter?
Does it? I'm not sure.
Yeah, not sure. Okay, then how do we figure it out, the cost?
Is it 240?
240. How do you know 240? Chetan?
This is the previous ones that were.
Ah, very good. They are saying, are they saying? Ah, no, they are not saying, but they are saying, no, they are not saying. How would we know if it is the one that we purchased on the 4th? We don't know. It can be or it cannot be. We don't know. Then how do we know? But we can calculate how.
Isn't the 20 equated to 1 by 5?
Sorry?
It's 240.
How did you get 240?
Very confused.
Ah, very good. You remove the GST. Yeah, how much is without GST?
130, 1200.
1200. Yes, 1200 for how many units? 5. Then what do you do?
5.
Divide by 5. Yeah, very good. Thank you. Then 240. Yep. So then we have 245 at 240, 1200 going out. Then again we are coming back to the same thing. 17 net 240. Yep. Which is 4080. And again 6 at 250. Right. 19. Purchase 30 cameras at 286 including GST. Right. Invoice. Right. In or out? Yep. In. How much is the price?
260.
260. Very good. Everyone is okay? So now we have 3 cost prices, guys. 17 to 40, 6 to 50, and now new one 30 at 260. Right, next one 20 4th sold 20 cameras. Receipt. It's a receipt 98. What is that? What kind of sale? Cash or credit?
Cash.
Cash sale, yeah? Very good. How many? 8 at 240. $19.20 and 12 at 260. 0 2 3120. Okay, next one. 28, yep. What is happening on the 28th? Delivered 4 cameras with the cost price 240 each. to be used as display in shop. Memo 37. What is that? Oh, what is that?
Out.
Out. Very good. So why do we use it as display?
Huh?
Why do we use it as display?
So people can see what they're buying.
Yeah. What do we call it? Inventory used for
Advertising.
advertising purpose. Very good. Right. So forward 240, which is 960. Then what we are having is 5 at 240.
4. Oh, not yet.
5 up. 1200. 6 250. 18 260. Next one, 20, sorry, 30, sold 15. 15 cameras, right? Invoice 89. 15 in out. 15, all of them purchase 19. That means what's the cost price? 260. Yeah, thank you. 0, 15 times 6 is 9, 3900. 5 to 40, 6 to 50, and we have 3 at 260. Okay. 0, 0, 18, 780. Right. Okay. On the 31st. What is physical inventory take, guys?
Count.
Sorry?
Count.
We are counting the inventory physically. Why do we do that? To make sure whatever the inventory recorded in the inventory card is actually or physically available in the store. Right? Makes sense? Which one is then more accurate? Physical inventory take, yep. So physical inventory take is the one that supports faithful representation. Why faithful representation? How come? It's actually a theory question. How come it's a faithful representation? Because it ensures that reports are free from material errors, yeah? They're accurate, yeah? Okay. Now guys, 31st. Memo 38. Now what is happening? They are saying physical inventory take says that 4 cameras at 240. Now how many do we have at 240? 5. Then what has happened to the other one? Theft, yeah? Lost, yeah? Then what do we record? Where do we record? In or out? Out, yeah? So then we have lost it, our inventory decreases. Firstly we'll write 1 at 240. Right, then second one says 6 at 250. 6 at 250 is there, no problem. So then let's update it firstly. We have 4 at 240 and which is 960 years. Then we have anyway 6 at 250. Nothing has happened to that. 1500. Then they are saying again what? 2 at 260. We have how many? 3. What has happened to the other one? Lost, gone. Right? 1 at 260. also 260, right? Then we have now 2 at 260, which is 520 up. Okay. Now guys, if we add this thing, you don't have to add it, I'm just showing you. Let's say if you add these things, 089 2980. What do you call it? 2980, what do you call it?
Inventory.
Inventory. When? As at when?
As at the end of the period.
Yes, the closing inventory. Yes, this is what you record in the where what you report in the balance sheet. Very good. This is going to the balance sheet. Imagine this is the only inventory line they have, and this will be the inventory that they will report in the balance sheet under current asset, right? Okay. Now, guys, we are done with part C, and now we'll do part D. What does it say? Record the following transactions in the
Can I read one?
Yeah, go. Anyone wants to go to the bathroom? Yeah. I will take a break, yeah? Go. Right. No problem?
How'd you get 260 for this?
260 is 30th. Ah, yeah, see? This one? Sold 15 cameras,
Yeah.
right? All of these cameras were from the inventory purchase on the 19th. So 19, what is it? 30 at 26. Yeah. So 19, 26.
Yeah.
Which one are you? That's what I said.
Okay guys, let's start. So we have to do the double entries for what? Firstly, 4th of May. What has happened on the 4th of May? Yep, we sold 35 cameras, yes, to GQ Design, invoice. So what sale is it? What sale is it?
Sale.
What sale is that on the 4th? Cash or credit?
Cash or credit?
Yeah,
It's
credit.
yeah.
How do we know?
Invoice.
Invoice, very good. So then we write the double entry, guys. So write the date firstly. May 4. Where do we debit? What's the double entry for credit sales? Remember? Yeah, forgotten the double entries? Yes. Anybody? What do you remember, Dan? GST credit, yeah. Accounts payable. Yes. Accounts receivable debit. Accounts receivable, we have write the name. Why? If you know the name, we have write it. Yep. GQ Design. Yeah. Then you debit, you said you credit the GST clearing, and where else you credit? Very good. Sales. Right? Then how much is it? The sales 500 times 35. Yep. How much is it? 110? No, 17,500. Yes.
What's the name of that?
GQ Design. Yeah. It's not clear enough. Right. GST 10% of that. All of them we are debiting to the accounts receivable. Everyone is okay? Now by this time all of you should be good at these double entries, guys. Okay? We have done many times. Then what is the other set of entry? Cost of sales, yes, Trethan, cost of sales, debit or credit? Debit, very good. And where do you credit? Wonderful. How much? What's the value? Yeah, how much is the value? Yes. Satum, how much is it?
There's two.
Yeah, what are those?
240, 250. Oh, but you do the total, right?
Total, yes. Total of what? 5,000, 520 and 3,000, which is 8,520. Yep. Very good. 8,520. Clayton, you okay?
Yeah.
You know how we figure out?
Yeah.
Good. Right. Do we need narration?
Does it
We don't, yeah? Not required. Good. Right, then what is the next one, guys?
7.
May 7th, yep. Uh, 7th May.
Isn't it capital?
Capital. You sure?
No, like so they take it home, right? So the inventory drops and then capital.
Was that capital?
Drawings.
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 Yeah, forgotten, guys. How?
Huh?
How did you forget it? Right. So we debit the where? Where do we debit? Drawings. Because drawings increase. How much? 500. Where do you credit?
Inventory.
Inventory. Why?
Because it decreases.
Inventory and asset decreases. Yep. Everyone is okay? Atom? Okay. Next one, guys. Right. Next one. 12th, yeah? GQ design return 5 of the cameras. Right. Now we are getting what return, guys? Sales returns or purchase return? Sales return. What's the double entry for sales return? Thanos, do you remember?
Inventory.
Inventory.
Sales return.
Inventory debit. Where do you credit?
Sales return.
No.
Isn't it? Wait. It's
Yeah.
a sales return, right? So
Yeah.
inventory credit and then sales return then.
No. Firstly, we'll record at the selling price. Like we did here, see? What did you do in this case? We recorded at the selling price, yes? Yeah? So then, what do we do? Instead of sales, we will return in the which account? Sales returns. How much?
Did I say?
How much in the sales returns?
2,500.
Sorry?
3,500.
2,500. Why? Because our selling price was how much, Nevin? 500, yep. 500 times 5. 2,500. And then GST clearing. How much? 10%. 250. And where do you credit it? Tanush. Where do you credit it?
Accounts.
Accounts receivable, yep. $2,750. And then you debit, now you debit at the cost price. Inventory and you credit the cost of sales. How much? How much is it?
1,200.
1,200, yeah, thanks. 1,200.
Does it say which accounts receivable it is?
Sorry? Yeah, we have write the name. I forgot. GQ design. Right, so inventory debit 1,200 and cost of sales credit 1,200. Okay, guys, next one is 15th. What is happening? We return it back to the Fisher, Kingfisher. Yeah, who is Fisher? Seller, accounts payable. Yep. What's the double entry for that? Tanush. What is that? What is that transaction? Purchase return. Very good. What's the double entry for purchase return? Exactly opposite of the purchase of inventory on credit.
Accounts receivable debit. GST.
Accounts receivable.
No, sorry, accounts payable debit, GST clearing debit, and then inventory. Oh no, GST clearing credit and inventory credit. Accounts payable is Kingfisher.
No, I was kidding. It is Fisher Clicks.
So what? Oh, Fisher clicks. Oh, I didn't read it.
Yeah, Kingfisher is bird, yes. How much though? 13? 20, yep. You debit you credit inventory 1200 and you credit GST clearing 120. Okay guys. Next one. 24th. 24th, what is happening? Nevin, can you tell me the double entry for 24th?
Debit bank,
David Bank. How much?
11,000.
Hmm?
Credit sales 10,000.
Hold on. Debit Bank 11,000?
Yeah.
You sure? Ah yes. Sorry, you are correct. 11,000. Then
Credit sales 10,000.
yep.
Credit GST 1,000.
Yeah. Good. We are running out of time. Not time, sorry, the space. Yep. Right. Bank debit 11,000. Sales 10,000 credit and GST credit 1,000. And we debit the. Okay, what's the next set of entry? That's all. Yeah, we recorded now at the selling price, yes? What is the double entry at the cost price?
Inventory credit
Yeah?
240.
And yeah, where do you debit?
Is it cost of sales?
Dion, where do we debit?
For
For the second set of double entry, for the 24th, we debit the cost of sales, yes? How much? Pratham, is it 240? No. Then how much?
I was reading 31.
Yeah. 24th, how much is it? How do you get the cost price?
5,040.
5,040?
Is it 1,920?
Sorry?
1,920.
Only? Yeah, 5,000? Yeah. Not 1920. Only 1920? Setu? Okay. You had what you have to do? You have to add them together, which is 5,040, correct. Pathum, you okay? Yeah? 5,000. You know how we got 540, yeah? 5,040. Cost of sales and inventory. Right. Okay, last one, 31st May. What's the double entry? I didn't ask you anything. What's the double entry for the 31st? Sorry?
Inventory loss.
Inventory loss, debit, credit?
Debit.
Hmm? How much? How much? How do you find it?
$500.
500. Okay, everyone is okay? Inventory loss is 100. Good. Okay, guys, the last part of this question. Calculate the cost of sales, firstly. Now, how do we calculate the cost of sales? Tell me. Big process, yeah? How do you calculate the cost of sales? Sorry?
Total of that.
Total of everything, where?
Out.
Out, all of them in the out,
EHS.
and invoice, except the memos. Why do we exclude the memo? And also credit notes. Why do we exclude them?
It's on credit.
No.
No, because memos are
Memos and credit notes are not the
business sell.
not the sale of inventory transactions, right? That's why we exclude what? Memos and the credit notes, right? So then, what are the things that we have to add, guys? First of all, okay, let's add together. Oh no, we'll do in the, that's why we have been given space, working space. 5520 plus 3000. Five 20 plus 3000 plus 1920 plus 3120 then 3900. How much it is that one, guys? So that one is giving me 17,460. Right? Is that the cost of sales? $17,460. Is that the cost of sales? No. Then what is it? We have to minus what? Sales return, yes. How much? Sales return was 1200. 1200, yeah?
Isn't that 2,500? Oh no, sorry, no, you're right, yeah.
Yeah, we have to get the cost of sales, cost of the
Inventory.
inventory, guys, okay? Minus 1200. So then, how much is it? Cost of sales is 16,260, yes? Right. Then, we got the cost of sales. How do we calculate the gross profit then? I'll just rub this part for a while. How do you get the cost of sales? We have to subtract it from the, how much? What? Sales return? No. From the sales. Or otherwise we have to say net sales. We have to subtract it from net sales. How much is the net sales? I'll tell you an easy method to figure it out. Okay. Do you think that their selling price is same or their selling price has differed? Changed. Change? You sure?
Like selling price of the inventory, right?
Yes.
Yeah, it's changed.
Change?
Yeah, because it goes 240, 250, 260.
No. Is that the selling price?
Oh, no, yeah, you're right.
The other? Cost price. Yes. How do we know selling price? Okay, let's calculate. Let's go through. Now what are the selling? Fourth. Yep. How many? 30. We have sold 35 units at 500. Then again 24. We have sold 550 including GST. That means still selling price is 500. Okay. 20. Any other sold? Yeah, 8250 for 15. So without that is also GST. Without GST, how much? 7500 divided by 15. How much is the selling price? Still 500. That means selling price hasn't changed. Then now how many have we sold? 35 plus 20 plus 15. Then we have, from that we have to subtract what? Yes, Navin? Purchase return. We are calculating net sales, not purchase return. Sales return. Yeah. How much is the sales return? 5. See. Alright. That means 35 plus 20, 55 plus 15, 70. Take away 5, 65. Then that means how much is our total sales or total net sales? 65 times 500. Yeah. Agree with me? That's the easiest way to do it. I mean, you can calculate other ways as well, but that's quite simple. I'm getting 32,500 net sales. So then we can calculate now gross profit. 240, 16, 240. Okay, how do we calculate the adjusted gross profit? Inventory loss. We have to adjust for inventory loss again. In this case, inventory loss, which is how much? 500 as I remember. Right? So how much is the 15? 740. Any questions? Yeah, everyone is okay. How did you find that question? Easy? Hard? Moderate? Okay. Alright guys, we'll do the next one. Do you want to try it or shall we do together? Yeah. Do you want to try it or shall we do together? Right. So then I start. Okay. Can anybody answer the question? First question. explain how inventory is valued under the FIFO. Yep. Nobody knows. How do we value the inventory under FIFO? Huh? What does FIFO, how do we operate FIFO? Or how does FIFO operate? No one knows? No? What is it? FIFO is assuming that the oldest, right? Oldest inventory that came to the store or to the business is issued or sold first, right? Right, let's write it. FIFO assumes that the oldest or latest sorry, my bad, not latest, that's wrong. Oldest inventory Right. Part B. Discuss whether Smith's cameras should use identified cost or FIFO. Discuss. But how do we answer that? Discuss. How do we answer discuss questions? Yeah?
Is it positive and negative?
Very good. We have to say positives and negatives of what? Of the FIFO and, in this case, identified both. So otherwise, we can discuss it together. Okay. So right there. FIFO is cheaper in administration
What does that say? That last one?
Cameras. Okay, sorry guys, before we, everybody is done? Yeah. Before we do the question, I forgot, still we have a little bit of theory, yes? We will complete that as well. Right. Now we are done with the FIFO and, we are done with identified cost recording, but we didn't do FIFO as yet, but we are doing it. The difference between the valuation of FIFO method and identified cost, right? So basically, is there any difference? Yes, especially when the inventory prices are increasing. If there is an inflation in the country, if there is an inflation or there is an increase in prices. Excuse me, right? So then, as a result, we have to compare these two methods, right? So let's compare it. Right. When inventory prices are what? When inventory prices are increasing. Inventory prices are increasing. Right? The cost of sales under FIFO is expected to be what? Cheaper when the inventory prices are increasing. Yep, will be cheaper, yes? Lower than, right? Or cheaper, lower than identified cost. Right? Therefore, net profit will be what? Higher under FIFO. Wonderful. Why is it higher? Because the under the FIFO, we always issue the oldest inventory, which is relatively cheaper, right? Then as a result, we are getting a higher price. We are getting a higher net profit than our cost of sales will be lower, and then under FIFO, we will get a higher net profit, right? Than identified. Then let's on second one. When inventory prices are rising or increasing, right? The inventory at the end of the period is expected to be what? Under FIFO. Inventory prices are increasing. Inventory at the end of the period is expected to be higher or lower under FIFO. Now we have what has happened now. We have issued all the cheaper ones first. And what do we have now? Higher prices, right? So it will be, we will have more expensive inventory right now. So it will be higher. Under 5.4, then identified cost as the less expensive inventory will be sold first, leaving the more expensive inventory in the business. Right. Next one. Perpetual system of recording inventory. What is that? Perpetual inventory system. Anybody heard it? We have done in Unit 2, yes? What is perpetual, guys? What are you doing?
No? I'm checking the time set. It's ticking really slowly.
Okay. So, perpetuity. You have heard, like anybody who has done general maths or doing general maths. What is perpetuity?
It's like when you take money out of like a savings or like a interest account, but the amount that you started off with in the account stays the same when you take the money out.
That means you can take the money for how long?
Forever.
Forever. That's the thing. Same thing, perpetual. Perpetual means what? Continuously. Perpetual means perpetuity is in terms of investment, he explained. Perpetual means what? It's a continuous process, continuing, right? So then perpetual inventory means, remember what we did here? What did we do? Then and there, or at the end of each and every transaction, what did we do? We updated the inventory quantity and the value. That's the perpetual inventory system. And also the other thing is, in the perpetual inventory system, what do? We do a physical inventory count. Okay, physical inventory count. Right? So then we can calculate the inventory losses and gains. Right. Now these things, guys, very important. Coming to we see benefits of perpetual inventory system. What are the benefits? Right. First of all, we can do the reordering of inventory. Why? Because at any given date, we can identify what inventory is having there, right? So that before we run out the inventory, we can order. Make sense? Right? Second one, inventory losses and gains can be detected. How? Comparing with the inventory balance in the inventory card and the physical inventory count, right? So that's how we can do inventory loss. Remember now we did in the previous question. And also third one, fast and slow moving inventory lines can be identified. Why do you want to identify fast and slow moving inventory?
So we know which ones to stop selling and which ones to
Yeah,
sell more.
whether you are going to stop it or even if you are going to continue, still you can order less in slow inventory because why? We are selling less, not much. And fast inventory, what can we do?
Increase.
We can increase the quantity, yeah? So because why? It's moving fast. Right. Finally, interim reports. What are the interim? Have you heard interim? No? Interim reports. Interim reports means sometimes we might have to do the reports in the middle of the period. So if you prepare the reports in the middle of the period, we do the what are you doing? Are you listening?
Yeah.
What are the interim reports, guys?
I'm not sure.
See, I told you that these are important. This is coming to easy. Okay, leave it. Please. Right, now see, you are wasting your time. Okay. Now I shouldn't be doing this like police work. I call them police work. Why? Police, like police, police, what do they do? They are hiding themselves, like especially on the road, and they are, checking our speed. And I shouldn't be doing police work. I don't want to be a policeman. Otherwise I shouldn't be here, yes? You to be a policeman. I don't like that, right? Because all of you are adults, yes? I mean, not really adults, adolescents. Not adults or not small kids. So then you have to behave yourself, guys. I should be pointing at one each and every one, okay? You have to, because now this is your last day in the school, yes? Right? Are you 18, guys?
No,
Not
very,
yet.
very far from 18.
So you will be 18 soon. So you have to listen, right? Interim means the reports that we prepare in the middle of the period. Okay, so then sometimes managers or owners will have to do the reports for some reasons, right? In the middle of the period. Usually we prepare reports at the end of the period, yeah. But sometimes we will prepare in the middle. So then, what can we do? Then quickly we can calculate the cost of sales, closing inventory, everything. Then we can prepare the reports quickly. That's right. This perpetual system will help us. Right. Then what are the costs, disadvantages of the perpetual? So first of all, guys, like see the businesses who are running a perpetual system, right? What are those? Like supermarkets, right? Maybe Coles, right? They need to have this system. Why? Otherwise, they will realize that some inventories have run out. They want to order, right? So then they can easily monitor their inventory levels by a system like that, right? So then basically when they sell it, automatically it is updated in the inventory card. Now see, when we scan, right, when we scan the items, then in the inventory card automatically updated. Okay. So then, however, the setting up and maintenance of the technology is expensive, right? And we need staff, more staff. It is expensive, and also they need to train them, right? So then it will increase their training and wages costs. Right. Let's continue the question, guys. Right. Okay, this one. We are having 40 GoPro cameras at 240. Okay, again it's there, 40 at 240. Right, second purchase 20 at 250. Right, fourth. Sold 41 cameras. Right. Now this is the problem. How do we record it? Right? How do we record it? 41. Right? Invoice 76.
Maybe.
Okay? We sold 41. Now what will happen? Now how do we record it? Now remember, this is what? FIFO. Right? How do we record it, guys? The out.
The first one.
First one. They are selling 41. Then what can we do? We have 40 at 240 straight away. We can issue that first. Then we have to issue one at 250. Yep. Okay. Now please follow me. Right? How you record it. Now you are not going to record here. You are not recording in this row. Okay? What do? We are record the next line. Then we are recording. We have how much? 19 at 250, which is 4,750. Yep. Okay, guys, what is the next one? 7. James took home. Sorry, not James. I'm looking at the other question. Daniel took home from inventory two cameras. So he took home 2 cameras on the 7th. At which price? They haven't given us. 250? Yes, 250. Yeah, because that's the only inventory that we are having right now. 2 at 250, which is 500. And then we have 17 at 250, which is 4,250. Right. Next one, guys. On the 12th, what happens? 12th, they are returning. Who is returning? Donald Studio. That means from the 4th. Studio returned 5 of the cameras. Right. Because the model was not correct. Right. Now the question, how do we value the cost?
Is it to reverse it how it's
Very good. You remember that. Good. Reversal of the FIFO, yes. Now firstly we'll write the credit note 21. Right. Now we are going to reverse it, guys. Now have a look. Now remember my rule? Remember the rule I gave you? Yeah, here. At the beginning, yeah. This is the one. Valuation of the cost of sales for sales returns under FIFO. Reversing FIFO. So that means, what do? Whatever the things that are in the out column. So what did we assume in FIFO? Whatever the things in the out column that were the last. Right? The last out items will be the first to come back. Then, do we need to go to that particular transaction on the 4th? No. Whichever that we have issued first, regardless of the transaction. Right? That's what we are going to record. Now, they are returning 5. Now we will count. Now we have 2 here. We have 2 here. And we have another one here. Both of them are at how much? All 3 of them are at 250. Then we need 2 more. Then we have to take that 2 from where? From the 240. But when you record it, now have a look. You are still following the FIFO, which means the first inventory that came first. That means we will write firstly here 2 at 240. Then 3 at 250. Make sense? We will write still the first inventory cost we will be recording first. 2 at 240, 480, 3 at 250, 750. Does that make sense? Now, do you want me to further explain why we reverse it like that? You want me to explain it or you understood? Why, Gavish?
What?
Can you tell me why it is?
Why you?
Yeah, why do we reverse in FIFO like this?
First in, first out.
Yeah, you know why? Basically to make to actually reset the inventory card into a situation where the sale transaction that created the the sales return never took place. For example, now they are returning, now how many did they purchase? 41, yes. After that they are returning how many? They are returning how many? 5. That means what is their net purchase? What was their net purchase? Or net, how much did they purchase at net? 36. Yeah, 36. Right, makes sense? So had they purchased 36, what will happen? Basically this one wouldn't have been 40 here or 41. It would be only 36. 36 at 240. And as a result, all the other inventory will be recorded at what price? 240. Makes sense? So basically, then we don't have the other prices at 250. We don't have these 250 prices. Why? Because they purchased only 36, not 41. Make sense? Right, then what will happen to our balance? We will have 2 at 240, 480, and we are getting 22 at 250. Yep.
What is it, 22?
It's 20.
Sorry, my bad. 20 at 250. Right? Okay guys, what is the next one? 15th, yep. Return to fast clicks, the 5 cameras returned by Donor Studio for a total credit of 1320. Now what happens here? Now what are we returning? At 1320, which is the cost price will be how much? 240. Yep. Okay, but however, we don't have 5 at 240. Yep. We don't have 5 at 240. We have only 2 at 240. So then we will be issuing 2 at 240, 480, and 3 at 250, which is 750. Right? Again, we are coming back to 17 at 250, 4,250.
Do you record at the bottom of it or do you record at the top of it?
Sorry, which one?
Your final one. Do you record at the top of it or the bottom? Like,
You mean the balance?
yeah,
Yeah, balance you record in the last one.
the last one?
Yeah. Remember, Jigavesh, we recorded the same thing here, see?
Yeah.
This one also, same thing. Right, next one. 19th. Purchased 36 cameras at 286. That means again, no GST. Without GST, it will be 260. Invoice C786 36 times 260. 00 9360. Yep. Then we will repeat 17 to 250 and 36 260. Next one, 24th. Now we are selling 20 cameras. What would be our prices, guys? Receipt 250. We'll have to issue how many first? 17 at 250, 4,250, and how many more? 3 at 260. Yep. 7,
17. Isn't it 12? Oh no, sorry, not bad.
20. Yep.
Yeah.
You're looking at the previous question,
No,
guys?
I wrote my 7 like really badly.
Okay. 7 at 260. Yep. Then what do we do? We are having now 33 at 260. Yep. Which is 8,080.
Is it 8,500?
580, yeah, thank you. 8,580. Then what is the next one? 28th. What happens? Delivered 4 cameras, 4 display. Yeah. Memo 37. Anyway, we have at 260. No choice. 1040. 29. 7540. Right, then we have 29th. No, sorry, 30th. 30th we have what is happening? We say 15. So we have anyway one inventory price.
Do you have to make the space, or can you just...
No, you don't have to make a base. I'm just making. Right? You don't have to do it. How many? 15 at 260 again. 0, 15 times 6. 3,900. 14 at 260. No, 36. Three, 6, 4, 0. Right. Then last one, 31st. Yep. Memo 38. Physical inventory text says that only 12 cameras left. Now what has happened? How many do we have now? How many do we have now? 12, yep. So that means inventory loss or gain? Loss. 2 items at 260, then 3640. Sorry, 520. Okay, what if this one we had another item at 240? Let's say one at 240. Then what will happen? Then what would be the
One from each.
one from 1 each, yeah? One at 240, one at 260, right? Good. Then we are having 12 at 260, 3120. Okay. Also, now let's say this one was not inventory loss. Assume they are saying the physical inventory track is saying 15 inventory is there. Then what will happen? Memo is saying not 14, there are 15 items. Then what will happen? Yep. What will happen then? What do you call it? Inventory gain. Or at how much are we going to value it? Remember my rule? What was the rule? You can't remember? Value in the inventory under 5.4. Inventory gains. See? What did you do? Most recent or latest value of inventory that came in, which is in the in column. The most recent item in the in column is the one we are taking the value from. Make sense? Right? Then if this shows an inventory gain, at which price are we going to value? 260. How did you get 260? Where do you get 260 from?
24.
From the 24th or 19th? 19th, yeah? You will use this one, 19th, which is 260. Why? Because that's the most recent in item in the in column. Does that make sense? Can it be any transaction? Yes, it can be any transaction. It doesn't have to be a purchase necessarily. Let's say we had, let's say for example, on the 30th, or not 30th, so let's say for example on the 25th, we had the memo. That means the owner is giving item. Let's say one at 270. Then what value would we use? This is the value we would use for the inventory gain. Right? Whichever it is in the in column, that's the one we are thinking that has caused the inventory in. Okay, it doesn't have to be a purchase. Right? Okay. So even if it is like more than 1 unit, still can we use? Yes, same price. Still we are using the same price. Okay. Right, that's it. Then party. No. Calculate the cost of sales and gross profit. Shall we calculate quickly? How much did you take? Yeah, how much is the cost of sales? How much did you get? I got 18,780. Is it correct? No, sorry, my bad. I think from that I have to subtract. I didn't subtract the credit note. 480 and 750. 17,550. How much is the total sales? We have sold 41. Then return 5, that means 36. 36 plus 20 and 15. The 71. We sold 71, yep. 71 times 500. 35,500. How much is the gross profit? 17,950. Then we had what is it? Inventory loss. And then how much is the inventory loss? 520. And then adjusted cost profit is 17,430. Okay. Right. Then is that enough for today? Right. So now, any questions with guys? Inventory losses, gains, sales returns, FIFO identified. Any problems? Okay. Alright, then thank you guys for coming today, and we'll see you same time.